that all swans are white. And finally, we get tied up in the details and information. Again, the more information one has, the more one will see the noise and mistake it for actual information. Now I want to come back to the program choice that we made earlier, page 12. So without looking back at the first answer that you gave, I want to ask a question again, and the questions are different, but it's similar this time. Again, imagine that Tucson has the risk of a flu-like disease and 600 people will die. Program A, if you implement it, 400 people will die, and program B, there's a 1/3 probability that nobody will die and a 2/3 probability that 600 people will die. Which would you prefer here? Okay, take just a couple seconds and do that. Now, a comment about this particular exercise. This has been done on a lot of different populations. It's been tested many times over, and there are a lot of variations on the theme that you can find in research, including financial ones. I wanted to stay away from the financial because I wanted to illustrate really the breadth of how this works. Now, quickly then, glance back to your answer on the previous program. In case you don't remember what it is, glance back. Now raise your hand. How many of you selected option A? Up, 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 so everybody can see so we can get a feel for this. Up, 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 up. For, if you go back to the first one, option A. How many of you selected option A? Okay, looks like maybe a bit more than half or so based on who's left. How many of you selected option B? Okay, actually option B is a little about as strong. How many didn't raise your hands? I have a feeling there are a few of those out there. Okay? Now when you made that choice the first time, you were essentially making a choice that differentiated between a sure outcome and an uncertain outcome, or a risky outcome. Okay? Most people in that situation choose the sure outcome. We'll call it the bird in the hand approach, by a pretty meaningful margin. We're probably a little more evenly split here without actually counting hands. Now your response to the problem on this page. How many selected option A on this one? Just a handful. How many selected option B on this one? Ooh, lots. This is actually a very good indication that that we're a pretty typical group of people actually. With this problem, most people choose the uncertain option, or the risky outcome, option B, again by a meaningful margin, and in fact that's what we did. Now one more question, how many of you selected option A for the first one and option B for the second one? Raise your hand there. Okay, looks like about half of you or so, not quite. Now, if you didn't notice, you might do a little flip back here. These two problems are mirror images of each other. They are the identical problem. What's different between them is how they were framed or they were positioned. In the first one, we said how many people would be saved. In the second one, it was how many would die. And the way that we behave is when things are framed negatively, we tend to choose the certain option. And when things are framed, excuse me, I said that backwards. When things are framed positively, we choose the certain option. We tend to more. When things are framed negatively, we tend to choose the uncertain option. So it's interesting to see, I'm sure for yourselves, how that difference appears. And this effect, choosing one option or another, appears in lots of different kinds of decision making that we do. And it's called framing. Next page, that one. So framing is basically the form of how the problem is framed. And it's sort of a glass is half empty or half full kind of a situation. We have difficulty recognizing or seeing through the frame, if you will. And as a result, it's likely to affect our behavior, and it is called frame dependence. The opposite is frame independence. If how something is positioned really doesn't affect our decision making, then it's independent of that communication. It would be better for us if more of our decision making was framed in a manner that was frame independent. We might actually recognize that if you transfer a dollar if I've transferred a dollar from my right pocket and put it into my left pocket, I'm not any less or more wealthy. And yet, we have framing that causes us to think that. How does this apply to investing? A great example is in a distinction between paper losses and realized losses. Y'all know what that means, right? You've booked it for tax purposes or not. And we have a tendency to say that that I haven't really taken the loss if I haven't booked it for tax purposes. Well, your wealth has been altered. The loss is there. Just because the tax man doesn't know it doesn't mean that it's not there. One problem related to framing comes in how we use reference points to assess the actions needed. We end up making riskier choices, choosing the choice for the uncertain outcome, when the probability of ending up below a given reference point, here I've described below the corpus, below the amount you think you need to survive, based on what peer funds have done, if you're a portfolio manager or benchmarks. If we end up below, if we're going to end up below that given reference point, we tend to take riskier actions. Steve put, in 1995, I'm going to give you a couple examples. In 1995, there was a trader by the name of Nick Leeson who brought down Barings Bank. Barings was a 232-year-old institution. He lost $1.4 billion and caused the bank to collapse. And afterwards, he asserted that he, quote, gambled on the stock market to reverse his mistakes and save the bank. He was functioning on a paper loss kind of a frame, and that the losses existed to begin with. In December 1994, Orange County filed for bankruptcy. It was the largest municipal bankruptcy in history, and it occurred based on the investment strategy of the treasurer, a gentleman by the name of Dennis Citron. It was a combination of really his overconfidence in his interest rate forecasts and some other biases that caused him to get into trouble. There was an article published following the bankruptcy that quoted an Orange County official talking about Citron, and he said, quote, "He's competitive, and if he returns a greater rate on short-term money than most people, he considers that winning. It's pride. It's being above average. When he's trading, he's all business." So pride, being above average, winning. Did Citron's reference points correspond to earning a higher return than everybody else? Sounds like it. So the reference point in particular, when there's been a tremendous loss of wealth, there's a tendency for us to say, oh my God, I'm going to end up in the median selling newspapers, bet the bank. We take more risk, but it has to do with that reference point that's already there. The loss has already been taken. And yet we try to regain it, and we take more risk than we otherwise would. I mentioned in our definitions of risk that we all have different attitudes towards risk, but there are some patterns that have been identified in how we behave. Next page, thank you. A number of these bullet points identify factors that contribute to an individual being more or less tolerant. And I think as you look at these, you'll find that they're kind of intuitive. They sort of feel right. And there's a common thread across a number of them that has to do with security. If you feel safe and secure in your position in the world, you're more likely to take risk. If you don't, you're going to be less likely to take risk. So framing, reference points, inattentional blindness, these are hardwired cognitive kinds of things that affect how we assess risk, how we process life, really. On the next page, we'll take a look at our judgment, and that it isn't always what we'd like it to be. Now, these tend to be anecdotal, but they're quite evident. And these are mistakes in valuation. I mentioned three primary drivers when we suffer a relatively permanent loss in investments, and mistakes in valuation is one of them. Now, these, I believe, directly reflect an investor's knowledge of the game. The Madoff whistleblower, Harry Markopoulos, made a comment in his recent book. He, quote, "I learned that the industry is based on predator-prey relationship